Welcome to Oregon Cash Flow Pro. My name is James Barber. We are ready for our 1-year QDTE $10,000 investment update. A lot of you have been paying attention to this and following along. I'm going to give you a little bit of background, but we're going to get through this quickly. I'm going to give you the background. We're going to look at how did QDTE do? How did it do in relation to NDX or triple Q? And how did it do if we used an alternative method where we just invest in the index and take money out each week without having a covered call ETF? These covered call ETFs have been very popular over the last year, and a lot of them have not done very good. But most of the ones that are problem childs are individual ticker symbols, not necessarily on indexes. So this is very interesting. And of course, the setup to this. Where did we get our $10,000 investment? That is unique in this scenario and key to one of the things that we're doing. And I will also touch on the tax consequences. Okay. All right. Quick background. This was the deposit, the initial deposit that we made. We bought 251 shares. We used $10,000. It was just under $10,000. Right here. It was $99.73. That was the value of it on day one back on the 29th of January. Well, today is January 31st, but the last dividend payout for the year on the 1-year update was the 29th. So it was a full year. Here's where it started. Our initial investment. Here's our dividend dates. This is the dividend payout. Now, this is the dividend payout as a percentage compared to our original investment. Because a lot of these ETFs, as they do the payout, if the value drops, the dividend kickout will actually drop. So I wanted to track it in relation to what are we getting in relation to our original payout. Because we're going to be holding on to this for a few years. And we have the dividend payout annualized. We have our realized gains. So this is the actual dividend that we got. If we get 100% return on capital, this is our basis. And our basis just goes down by the dividend payout each week. And then this is if we were to drip the shares. We are not dripping the shares in this scenario because of where we got the $10,000. And this is all part of this $10,000 challenge. We borrowed $10,000 from a life insurance policy. You know, here on this channel, we love talking about high cash value life insurance. We own a number of life insurance policies, and we tapped into one of those. We borrowed at 5% interest. It's simple interest. We don't have to make any interest payments, but we can. And if we don't make interest payments, the interest payment will just get added to the loan. So we don't want that to happen. We want to treat this just like any other loan. And the idea was, can I take that $10,000, put it into an index that I would otherwise want to invest in, which is triple Q. I want to invest in triple Q. QDTE gives me exposure to triple Q, but the fund itself sells a covered call 0 days till expiration every day that the market's open so that it can earn income, and that income gets kicked off as a dividend. And then we take that dividend to pay back the loan and the interest. So here's what we've got going on. If we didn't do that, we would drip the shares, and we tracked how many shares we would have when it drips. Down here at the bottom, we've got all of our totals, but I'm also tracking the current shares that we have because I'm eventually going to start adding shares to this once we pay the loan back. In fact, we'll probably just do it again. Borrow the $10,000 again, go back in and buy more shares. This is the current value of those shares based on the current share price. Move that down just a little too far. This is the current share price, our current shares, the total value of those shares. Remember, our value when we started, $9,970. So we definitely lost value in the actual shares, but we got a lot of dividends kicked out. And so this would be our growth if we didn't get dividends, or if we don't account for the dividends that it got kicked out. If we only accounted for our share value, but we actually got dividends. And so we have a growth with the dividends. So the dividends, let's look at the total real quick. The dividends totaled up to $3,700, which was an average. This is an average of 29% if I just take all of these. But it's not actually 29% because we started out with 10,000 and we got 3,700. So this was actually a 37% payout. But this is the average if you just took each week as if it was equal. But these ETFs, at the end of the year, they have to distribute 90% of the income. Otherwise, they have to pay taxes. So at the end of the year, we got these really big dividend payouts. $1.92 a share, $1.72 a share. They can't do that every week, but it gave us a really big boost in what it actually paid out. So total was $3,700. If we account for that, we had a 14.47% return. Not too bad. We actually would have $11,420 when we account for that dividend growth. But we didn't take that dividend and put it back into the shares. We paid off the loan. So we're going to take a look at the loan really quick. But before we do that, let's look at the dripped shares. This is the dripped shares. You can see the shares here adding up with the drip. Every week, the dividend would just buy more shares. So we would have ended with 385.72 shares had we done the drip, which means our value would have been 11,860, or a return of 18.88% on the initial investment. That's pretty good. So 4% better had we done the drip, a little over 4%. If we just put money right into the NDX, that's this right here. This was the value of NDX at the beginning of the challenge. This is where it's at today. We would be up 19.34%. So slightly better than where QDTE is. Now, when we started this challenge, QDTE had been outperforming NDX. But when you get really big volatile movements to the upside, that's the biggest weakness of these covered call ETFs, because you miss out on some of that upside. So this fell behind back in April when the market took a big, huge drop, and then it made a really fast recovery. Actually, I guess the recovery started in June, but it was a really, really fast recovery. And at one point, this was 5% over what the drip was at. And it was closer to 8 or 9% where we were at here. So we've been catching up once we got back into a less volatile environment. Now, I've got two other things that we're going to take a look at. Let's look at the loan. Here's the loan at the beginning of the year, all of our dividends. Now, I didn't move every penny over because I just rounded. And so what we ended up paying the loan down was $3,676. These are the loan payments every week. This is our 5% interest, and I just calculate it daily. Although what I actually pay will be less than that because of how interest is calculated on the life insurance loan. What actually happens on the life insurance loan is this whole payment goes to principal. And at the end of the year, we get billed for the interest each day. In here on my spreadsheet, I'm adding the interest each day. I shouldn't technically be adding the interest over here. So our savings are going to be a little bit more because our principal balance is actually going down faster because nobody's getting that interest payment. And also, I have this where the interest compounds daily, and we're not getting daily compounding either. So I'm being conservative when it comes to how I have this loan structured here in relation to how it's actually structured. But these are all the payments. And if we go to today, you can see our loan balance, $6,761. That means we paid down $3,239. The difference there is interest. So over the course of the year, if it was $10,000 for a loan, at 5% would be $500 in interest. Well, we didn't have $500 in interest because we've been paying it down. So we have a little bit of savings as far as what we actually had to pay for interest. Over here, our performance is about 5% less because we've been taking the money out and not dripping it. So we're 5% less when we account for the dividends here. And that's basically the interest that we're paying on that loan. So we're slightly underperforming, but when you account for the interest, it's almost a wash here between these two. So far, this challenge has been a success. I'm actually pretty happy with this. Let's look at the alternative, because you don't need to get into a high yield dividend ETF that kicks off income selling covered calls. You could just invest in the index and take the money out yourself. It takes you more time. You have to think about it. You have to actually go through the steps and decide how much you want to take out, but you could do it. And in this scenario, I'm showing the date. This is the value of the NDX. These would be the number of shares that we bought with $10,000. Now, NDX is like $22,000. So we don't quite get one share. It's a fraction of a share. And they don't actually sell shares either. But if you were able to get a share, it would be a fraction of a share. And then we didn't take any money when we first put the money in. The value today, this is where we got that other number. That would be the value if we didn't take any money out. And as we take money out, the value of our remaining shares goes down. So that's what you see happening here. Now it went up here because the market went up, and then it went back down again as the market goes down. Where we end up at the end of the year, we would have $8,019 left in here, and we took out the $3,700 in dividends. So in this situation, there's 8,000 of value. We're at 7,700 in value over here. We're only a little tiny bit behind what we would be at in that scenario. And the money that we took out was going to pay a loan back. So because of how the NDX did actually perform, we would be slightly ahead if we did it this route. But let's talk taxes, because this is kind of key to understanding why we decided to go this route for this particular challenge. In the first year, if you're taking out money and there was gains in that first year, you're going to pay short-term capital gains tax. Over here, almost all of this is going to be return of capital. Return of capital, we won't pay any tax on that. We do have gains in there, and those will be realized at some point, but not until after the first year. Or in the first year, let's say we end up with 90% return of capital. What would actually happen here is 90% of that 1,400 would be return of capital. 10% wouldn't. So we would have about $140 that we're going to pay short-term capital gains on. The next year, well, for 3 years, we're going to keep getting that return of capital. And the percentage is going to vary. We don't know what they're going to report as return of capital until the end of the year. But it is a pretty high percentage of return of capital. Once we get all of the capital returned, now that return of capital is going to be long-term capital gains because we will have held it for longer than a year. My expectation is the other returns, what's classified as not return of capital, at that point, it should actually also still be long-term capital gains for us because we've held these shares for more than a year. Well, they'll be qualified dividends at that point. They should be qualified dividends, which I believe gets the long-term capital gains rate. So really good tax advantage after the first year and during the first year. Whereas if we were just in the NDX, everything after the first year would be long-term capital gains and anything in the first year would be short-term. So if I were to do the NDX one and just hold it for the first year, don't take anything out for the first year, everything could be long-term capital gains. But my interest was in paying back that loan pretty quick so that we can then redeploy it somewhere else. So we opted to try this. And ultimately, I think there's a good chance that he will outperform the actual NDX again, unless we end up with a bunch of volatility that spikes up during the day. It's essentially greater than 1% is what it has to go up for us to fall behind what it's actually doing because of the covered calls that are being sold. So really happy with this. I like our position. I like what it's doing. I don't know what the dividend is going to end up paying out once we get this loan fully paid back. And then we still have our shares and it'll still continue to kick off income. But we like the underlying. We wanted exposure to the underlying. This is critical. I wanted exposure to the triple Q. This is one of the ways I chose to get that exposure. I have good S&P 500 exposure in my IULs. So I don't need exposure to the S&P 500 in something like this. And it turns out the S&P 500 is less volatile, so the dividend returns will be lower. But there are good S&P 500 indexes that are just like this. And we may end up expanding into that in the future, but that's not where we were starting. There's a number of high yield dividend ETFs like this. You've got RDTE and XDTE from the same companies, but they're using Russell 2000 or the S&P 500. But it's a little lower volatility, and so the dividend kicks out a little bit less. But if I want exposure to a different market, then I might utilize those if I'm doing something similar to this. This could also work out if you had a lump sum of money that you needed to do withdrawals for income, but you didn't really want to manage it yourself. You didn't want to go in and figure out how much do you want to pull out each week, but you definitely wanted to pull the money out. And so this kind of is a slow way to pull it out. It's like instead of dollar cost averaging in, it's like dollar cost averaging out, and you may be left with something at the end of it. It's always going to depend on what the market does, what the actual market does. There's no guarantee that we will make money in this. The dividend rate could continue to keep dropping. We look at the last 3 dividend payouts, they were very low in relation to what we had been getting. So there was a 10 cent and a 12 cent. And the market hasn't been doing bad. The lowest we had gotten in the prior year was 15 cents. We got that a couple of times when the market had dropped. So we have a 12 cent, a 10 cent, and a 16 cent. This could be a sign of things to come. We might be getting a reduced payout in the future. I was getting basically $50 a week, which translates into about $200 a month. That's pretty good if we think of this like a rental property. a $10,000 rental property that's giving me $200 a month. And once it pays that loan back, it may continue to keep kicking that out. Cool. That's where I like to view these in my portfolio. But down here at 29 and 24, now it's $100 to $120 a month. That's a lot less. But if my loan's paid back and I don't have maintenance like I would on an actual rental property, it can still work out good, especially for a $10,000 investment. But we're hoping that we'll still continue to see somewhere up around the $50. If we do, this will get paid off within 3 years. That was kind of my hope. We're slightly ahead of it because we went 37% instead of 33%. But if the dividends do continue to drop, it may take us just over 3 years to pay it out. It depends on how low they go. I hope you found this helpful. That's why we put these videos out. If you did, hit that like button. If you have any questions about this or suggestions, we're always open to that. This channel is about education, so leave those in the comments section below. And we're going to be back soon talking about some life insurance because it is key to my overall financial plan. My life insurance policies, we're really happy with what those are doing, the money we're putting into it, the performance that we're getting out of them, and the liquidity that we have to go do other things with the money that we're putting into the life insurance. This being one of those things. So, appreciate you. Good luck to you out there. I hope to see you again. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.